Hello, welcome to Chapter 3, Ratio Analysis, Liquidity Ratios for Business 311, Huntington College. My name is Dr. James Yohe. We'll get started. This chapter, you can read right here, we're dealing with these 5 ratios here. Liquidity ratio is the one we'll do in this video. Additional videos, hopefully, we'll be able to address these. One thing you want to remember is you do not have to memorize the formulas for these ratios. But you need to know what they mean and what they are used for. Okay, so that's going to be important. We'll skip through these goals and get straight to Stockholders Report. Stockholders Report is where you're going to get most of this information. Inside of it are the financial reports. They are performed according to generally accepted accounting principles, which you can see are the practice and procedure guidelines used to prepare and maintain financial records and reports authorized by the Financial Accounting Standards Board. So for any sort of listed exchange, they're going to be using GAAP principles. One thing you always want to remember is that there are different rules for different things. For example, banks. Banks will oftentimes discount future revenues, say on a loan for servicing revenues, and they'll discount them into the present and book them all at one time. You have to look at the footnotes to see how revenues and costs are accounted for, and be aware that if you're comparing a company over time and you're doing this, say for an analysis for a bank or for investment company, or if you're even looking at it as your own investment, you'll want to go back to these statements if you're doing a time, especially if you're doing time series analysis, and you'll want to make sure that they account for these things all in the same way and that it's kosher for you, that you understand, are these revenues as they're earned, or are these revenues as they are paid? Okay, and other things. But I'm not an accountant, and I'm not trying to tell you how to do accounting. The first key financial statement is the income statement. Provides a financial summary of a company's operating results during a specific period. This could be quarterly, monthly, depending upon the purposes, or annually. And we're going to look at a income statement for a company you've all heard of, Alphabet Incorporated, also commonly known as Google. They changed their name a while ago. If you look here, we have an income statement. You've got total revenue. Those are oftentimes called sales if it's a retail company. You have cost of revenue here for Google. A lot of times, and in the book for Bartlett Furniture Company for sure, they call that cost of goods sold, COGS. So if I sold $1,000 worth of merchandise, COGS would be what I paid for it, maybe $500. And that would leave me with a gross profit here of $500. You can see it's different here. Then we've got operating expenses. They're totaled here. You subtract those, 33. Now remember, this is in thousands, and you've got to be aware of that. Okay, they tell you up there it's in really small letters. So this looks like, for example, here for total operating expenses, 49,664,000. No, add 3 zeros to that. That's actually $49,664,000,000. Okay, subtract that from gross profit. That gives us $33,128,000,000 in operating income. Okay. Now here, these figures here are actually additions, not subtractions. They earned interest income. They had these other total other income or expenses. These are income. So that brings us to income before taxes. Okay, sometimes called EBITDA, but this is not EBITDA. Okay, of 40,448,000,000. Then they paid $5,704,000,000 in taxes, income from continuing operations here, and that becomes their net income. And there's also income available to common shareholders. Okay, so that's your income statement. Going back to the PowerPoints here that I cut and paste, you can see this for Bartlett Company. We're not going to go over it. The next type of thing you look at is a balance sheet. We're going to get a lot of our liquidity ratio. We're going to get it off the balance sheet, and that presents a summary of a firm's financial position at a given point in time. Okay, so we will go back to our friend Google here. also known as alphabet. And you can see here, we're going to go to the balance sheet. That was the income statement we just looked at. We're going to go to the balance sheet. Okay. And over here on my little camera that I just waved my fingers in front of, we're just going to write these down. So one of the ratios we're going to be doing is the quick ratio, the current ratio. And we're going to take total current assets and we're going to divide them by the total current liabilities. So we'll explain this later. I'm just going to write the numbers down so we don't have to go back, constantly keep going back to this balance sheet to get them. Total current assets, we've got 135 billion, 676 million. Okay, we're going to cross those off. We're not going to use them. And then we're looking for total current liabilities. And you can see those listed here. And that's going to be 34 billion, 620 million. We're going to cross those off. Okay. Now, total current assets, if we go back up to the top here, okay, these are cash. I'm going to move you over so you can see them. These are going to include cash, marketable securities, plus accounts receivable, plus inventory. Okay, I'm going to circle inventory for a second. We'll be getting rid of it later. Okay, so there's the information we need so far for the current ratio, and we're going to also need inventory here. The total inventory, if you go over here, that is $1,107,000,000. Cutting off those 3 zeros just to make our calculations easier. As long as we do it to everything, it doesn't affect the answers we're going to get. So we go back here. The third statement we have is a statement of return earnings. You can see what that looks like here. Retained earnings balance at the beginning of the year and the return earnings balance at the end of the year. And this is how they got there. And then we have a statement of cash flows. Okay, cash flows from operating activities, investment activities, financing activities. You see there's dividends paid. We're not going to go over these financial statements. You'll go over that when you read the text. Now, the first set of ratios we're going to be looking at are going to be the liquidity ratios. But ratio analysis involves methods of calculating and interpreting financial ratios to analyze and monitor the firm's performance. Okay, different parties will be interested in this ratio analysis. You can see here we've got current and prospective shareholders are interested in the firm's current and future level of risk and return, which directly affects share prices. Creditors are interested in the short-term liquidity of the company and its ability to make interest and principal payments. This is very important. I was a banker, and one of the biggest things I looked at will be this quick ratio, or what we call the acid test. Before I even talk to a customer, the first thing I want to be able to the first bits of information I get, I'm going to do a quick acid test. I'm going to see if this firm has the ability to meet its current obligations before I decide whether or not I want to give it a loan or maybe even open a checking account for them. Okay, I don't want a company going bankrupt with an overdrawn balance on the account because I won't get it back. Okay, so I'm looking to see, can these people in the short term make their payments before I even talk to them? And then management is also concerned with all aspects of the firm's financial system. We're going to look at activity ratios and some other things that the management is always interested in. There's cross-sectional analysis, benchmarking, excuse me. Cross-sectional is a comparison of different firms' financial ratios at the same point in time. It involves comparing the firm's ratios to those of other firms in its industry or to industry averages. Okay, they do that in the Bartlett example, and the example that you're going to be using when we do the case study in class for Chapter 3. Benchmarking is a type of cross-sectional analysis in which the firm's ratio of values are compared to those of a key competitor or group of competitors that it wishes to emulate. Okay, and then comparison to industry averages is also popular. And we're not going to be using this example, but it says in the following example. You can see here, inventory turnover. Okay, Caldwell Manufacturing, they're turning their inventory over at a higher rate than the industry average, so they'd be pretty happy with that. All right, here are just different ratios: current ratio, quick ratio. These are the two we're going to be looking at today. Those involve the ability of this firm to pay its bills, basically. Okay. All right, we also have time series analysis. This is useful in evaluating the progress of a firm over time. Okay, is the firm, things within the firm getting better in terms of liquidity, or are they getting less or more liquid? This isn't always a good thing. Just because you're liquid doesn't mean it's good. Too much liquidity means that you have more cash than you need to pay your bills, and that this cash earns next to nothing in return. So we might want to invest that cash or pay it out as dividends. But we'll look at this over years for the same firm and compare and see how the firm's doing. Okay, here's an example for Bartlett. You can see here, average collection period. This you want as low as possible. It's going up. That's a sign that this company here, especially seeing that they're above average, that in order to make sales, they're giving credit to firms who are less able to pay their bills. Okay, they might be loosening credit standards on who they allow to buy furniture on credit, and that could be a problem. Financial ratios, you have to be careful. Okay, ratios that reveal large deviations from the norm merely indicate the possibility of a problem. Okay, you could have a different business model than, say, other firms in your industry, so your ratios might not match up. You might expect to have higher liquidity ratios if you're operating on, say, a just-in-time basis, and your competitors aren't. These are types of things that you would know and understand in operating your firm. A single ratio does not provide sufficient information from which to judge the overall performance of the firm. We never want to look at one ratio and say, oh, it's a good or bad firm. Okay. The ratios being compared should be calculated using financial statements dated at the same point in time during the year. So if we're using, say, time series, we want we want them all dated on the same day. So if we're looking at annual statements, we want them, say, all on September or October 31st or January, whatever, the same day. It's preferable to use audited financial statements. These are more reliable. There you have an accountant who's signed off and said, to the best of his ability, these are an accurate portrayal of the company in question. And the financial data should be being compared should have been developed in the same way. We talked a little bit about that before. If you, say, change the way that you account for certain types of revenues or costs, that can distort your calculations. And then, of course, we know that over time, money loses value. So results can be distorted by inflation. The first thing we have here is the current ratio. The current ratio is equal to current assets minus current liabilities. Over here, I've got those numbers. So we're going to figure out our current ratio. And we've got the information written down. So I'm going to move this down a little bit. And as you can see here, get this camera stay still. Apparently can't. There we go. We've got current assets on the top. That is $135,676,000,000. Remember, we cut the zeros off. because these are reported in thousands. And then we're going to divide by current liabilities. That's 34 billion, $620 million. I'm going to take my calculator out and make that calculation. And we get a current ratio of 3.92. I'm rounding. What this basically says is that Google has $3.92 in current assets. I'm sorry, you can't see that. That's my current ratio. Up here I have current assets divided by current liabilities. That came out to roughly 3.92. I rounded up from 3.917. And basically what that figure says, basically what that figure says, there we go. Basically what that says here is that Google has $3.92 in current assets for every $1 in current liabilities. Now, the current ratio is something that we use, but something that is probably a little bit better indicator of the firm's short-term run ability to be able to pay off its liabilities is something called the acid test or the quick ratio. And as you can see here, large enterprises generally have well-established relationships with banks that can provide lines of credit and other short-term loan products in the event that a firm has a need for liquidity. Smaller firms do not. So all other things being equal in a particular industry, larger firms would tend to have lower current ratios, or at least it's okay for them to have lower current ratios relative to smaller ones, because these larger firms generally have access to lines of credit and other short-term loan products to pay their bills if they need liquidity. Now here's the big one. This is the quick or the acid test ratio, quick ratio. Here, it's basically the same thing as the current ratio, except we subtract out inventory from the top. So here, for my acid, I call it the acid test because I was a banker, but it's also called the quick ratio. So I'm going to write them down here. Okay, that is equal to your current assets minus inventory. We take out inventory over current liabilities. So I'm going to take 135,676,000,000. Remember, I cut the 3 zeros off because these are in thousands. And I'm going to subtract out the inventory, $1,107,000,000. That goes on top, and that's going to be divided by the same thing we had before on the bottom, which is our current liabilities of $34,620,000,000. Okay, now here, the reason we take that inventory out is because we're looking at liquidity. Cash, you go back up to the top, these are all the current assets. Cash is the most liquid of all assets because it is liquid. It is the definition of liquidity. You can easily turn cash into other things, other assets. Okay, pay your bills with it. Marketable securities are highly liquid compared to the things further down on the list, because if I own stock in Google, I could sell that on the market very quickly and have the money in my account by that afternoon to pay my bills. Accounts receivable are a little bit less liquid. Okay, these are debts owed to us by our customers generally. So Google might have sold software to one of the cell phone makers, okay, sold them operating systems, but they're waiting on payment. So they may get 30, 60, 90 days, whatever, before they receive payment for those things. Now, these accounts receivable, you might think, oh, what if they're 30, 60, 90 days? They're not as liquid. They're not very liquid. But you have to remember, most firms can borrow against or sell their receivables. I had a customer once, was a manufacturer, and had a lot of receivables. There are asset-based lenders out there who would lend him money against his credit card charges, which are accounts receivable, because while the firm pays for it with his credit card, the business, their customer pays for it with the credit card. The firm has to wait until that clears. So they were using their receivables with an asset-based lender on a loan. But you can sell or borrow against them fairly quickly. But inventory is the problem, especially as a lender. I don't know if that inventory is easy to sell, how long it's going to sit on a shelf. Um, it could be fashionable or seasonal, and at the end of the season or when fashion trends change, it could become worthless. So we're going to subtract inventory out because it isn't very reliable. Okay, here's my calculator, and we're going to do the calculations. First thing I'm going to do, I'm so sorry, I have a really bad stand for this. It's not working very well. In fact, you might even say it's not working at all. There we go. So here we're going to take the current assets, 135 billion, 676 million, taking off 3 zeros, subtract out that inventory number, 1,107 million, and that's going to go on top. Then we're going to divide that by the 34,620 million, and that will give us a acid test of 3.8, 3.89. I rounded 3.89 for Google. So what that tells us is Google, or excuse me, I keep saying Google, it's Alphabet. Alphabet, formerly known as Google, has about $3.88 in liquid assets for every dollar in current liability. So this would, generally speaking, depending upon the industry, give us an indication that this firm is well set up to be able to pay its bills in the short run. Okay, thank you very much. I hope this helps.